If you fail to stick to your investment plan, you're not just going to lose your money, you'll likely compromise your future and miss out on the life that you've envisioned for yourself and your family. In fact, each impulsive decision you make now could chip away at the foundation of your financial future and lead to setbacks that can be tough to bounce back from later on down the road. Making a generational impact starts with one person, one family, one community. And so the Gen 1 legacy is my attempt to help first-gen tech professionals like you get your financial house in order so you can live your legacy. Hi, I'm dearly.So. I'm a functional introvert, but I generally enjoy public speaking. But it wasn't always this way. You see, when I was a college freshman, I did what any reasonable person would do to get over their fear of public speaking, and I signed up for a public speaking course. What better way to get over your fear of speaking than to get up in front of 30 perfect strangers and say something, right? Well, early on in this particular class, I was paired with a partner who we'll call Brian. And as part of our first public speaking assignment, Brian and I were tasked with learning as much as possible about one another in 15 short minutes. From there, it was our job to introduce each other to the rest of the class. So how'd I do? Well, I took careful notes, and when it was my turn to present, I walked up to the front of the class and I nailed my introduction. It felt great. But then it was Brian's turn, and Brian's presentation didn't go as smoothly as I anticipated. That's because Brian was more nervous than I was, and the coping mechanism for his nervousness turned out to be humor. Now, have you ever met someone who, when they get nervous, they just start cracking jokes? Well, unfortunately for me, to ease his tensions, Brian decided to use his budding sense of humor to make the class laugh at my expense. In fact, Ryan was so nervous that he didn't even bother to read from his note cards. The truth is that he just created a giant fictitious story about me simply to keep this shtick going. And so what happened? Well, just a few days after that unfortunate event, I dropped the course and gave up my public speaking pursuit for quite some time. Now, it took me a while to get back up on that public speaking horse, but had I been able to move past that one uncomfortable event, had I been able to look back at that one awkward circumstance and just taken it for the learning experience that it was, I wouldn't have wasted so much time not improving my communication skills. Now, have you ever been right on the cusp of achieving a goal, but walked away at the last minute because of a momentary setback? Thomas Edison was known to have said that many of life's failures are people who didn't realize how close they were to success when they gave up. That's why when it comes to how you or I manage our wealth, it's crucial to stay committed to a disciplined, long-term strategy no matter what's going on in the markets. More specifically, when it comes to prudent investing, reaching for shortcuts, whether that's looking for the promise of a safe haven financial product or the promise of a risk-free investment home run, rarely leads to the outcome that we're hoping for. That's why it's crucial to develop a disciplined investment strategy, understand where you're investing in the first place, and then stick to the plan, not to the panic. Because if you don't, you not only risk financial loss, you may be introducing unnecessary stress and anxiety in your life, which could ultimately set you up for financial and personal setbacks. Now, you likely already know that investing can often feel like riding an emotional roller coaster. But this feeling isn't something that we already appreciate until we're right in the middle of it. You see, years ago, when my oldest child was 9 years old, I took my family to Kennywood Park here in Pittsburgh, Pennsylvania. Now, having never been to an amusement park before, naturally, the kids all wanted to ride a roller coaster. And I'll be frank with you, because up to that point, I myself have never ridden a roller coaster either, so I didn't know what we were up for. And so we walked up to the first roller coaster we came across, called the Jackrabbit, and we got in line. And as we stood in line, we watched intently as others boarded the ride. And we shared in their excitement as the cars zoomed right past us. Now, by this point, all of us were excited and full of anticipation as we took our turn to get on the next available roller coaster. But as our car started to pull out of the carriage house and began its ascent to the top of the first crest, our entire family quickly came to realize that the Jackrabbit was no tame roller coaster. Now, have you ever been on a ride that didn't turn out as you'd expected? Have you ever been on a ride that you thought would be exhilarating, but suddenly took a sharp and unexpected drop? Now, can you recall how you felt in that moment? Well, maybe your heart started racing because you didn't know what to expect. And maybe you began to wonder why you ever boarded the ride in the first place, right? And even though you knew that that ride would be over in 90 seconds or less, you likely still felt like you made the worst mistake of your life and vowed never to ride a roller coaster again. That's how many of us feel when the markets aren't going our way. Frankly, we get scared. When the markets dip, the fear of losing hard-earned money takes over. That's because we're typically wired to avoid pain more than we're motivated to seek pleasure. And so, as you know, this fear can make us desperate for safety when we're in an uncomfortable position. At the same time, it can lead us to seek quick fixes of an annuity or the lure of a high-risk investment promising steady returns. But this approach rarely ever works. And why is that? Well, imagine that you're building a house. You have all the blueprints ready, you have a clear vision of what your finished home will look like, and so you get to work. Now, imagine that midway through your build, you decide to change the entire layout of your home because you saw a design in social media, or you heard about a tempting new building trend from a friend, and so you decide to mix things up. So what do you think would happen? Well, you'd likely face delays or increased costs and perhaps even structural issues with your finished home. Taking the same approach when it comes to investing is likely to yield similar results. Indeed, when it comes to investing, sticking to your plan is essential. And why is that? Well, let's consider the financial costs of missing the best days in the market. Now, historically, the stock market has provided substantial long-term returns for a diligent investor. However, these returns can vary by missing just a few sizable days in the market. How so? Well, let's say that you invested $10,000 in 1970 in a way that would track the S&P 500 index's performance. Now, if you left that portfolio alone, by 2020, your portfolio likely could have grown to around $1.2 million. But if you missed the 10 best days during that 50-year period, your portfolio may have grown to only around $600,000. And so why would this happen? Well, that's because the market's best days often happen close to its worst. More specifically, during periods of heightened market volatility, emotions are running high, and so many investors make the mistake of pulling out of the market at the worst time, thinking they can avoid further losses. But this reactionary approach can lead to missing a significant rebound just days after a sharp decline in the markets. I mean, just think about where your portfolio would be now if you completely sat out 2023 because you were disappointed by what happened in the markets in 2022. You see, it's nearly impossible to predict with certainty these days when the best days in the markets will actually take place. And as a matter of fact, they often happen unexpectedly, which makes market timing a risky and often costly strategy. That's why it's crucial, especially when the markets are moving against you, to stick to the plan and not to the panic. Now, besides losing out on potential long-term gains, panicking when you should be sticking to your plan can cost you your peace of mind over the long term. Sure, buying that annuity now or taking advice from a discussion board on how to take a big bet on a sure thing stock could help you in the short run. But what do you do when markets return to normal? Panicking instead of sticking to your plan and chasing after shortcuts is like taking a detour on a well-planned road trip. How so? Well, imagine for a moment that you've got your destination clearly mapped out, but along the way you keep hearing about shortcuts or scenic routes that promise a better or faster or more enjoyable experience. So what do? Well, you might change routes because you're excited, or maybe you're hoping that these new paths will lead you to your destination quicker or offer you more of a picturesque experience, right? But what tends to happen is that you not only find yourself more lost, but you also find yourself more stressed and further away from where you want to be. And this feeling is much like that emotional or that psychological toll of constantly shifting your investment strategy in search of a quick fix. Indeed, the first emotional hit you'll take from panicking in the markets is dealing with stress. That's because each time you switch strategies, you're betting on an uncertain outcome. In a way, you're hoping that this new approach will outperform your last one, but there's no guarantee it will. And the constant worry about whether you made the right move can ultimately become mentally exhausting. It's like being on that road trip where you second guess every turn you take and never feel settled or confident in your decisions. And then you have to deal with the feelings of losing control, because instead of following a well thought out plan, all you end up doing is reacting to market movements, news headlines, or the latest investing fads. And so when you take this reactionary approach, you're likely to feel like you're at the mercy of forces that are beyond your control. And so when you find yourself in this situation, it tends to create more anxiety and uncertainty rather than the certainty that you were looking for in the first place. It's like driving without a roadmap in a foreign land. You're relying on random road signs or gas station attendants for guidance that end up leaving you feeling increasingly lost and powerless. And so as you continue going down this path, you could end up paying the price of exhaustion that comes from the cycle of hope and disappointment. But ultimately, when you're constantly looking for a magic solution to solve your problems, then every new strategy brings with it the hope that maybe this one will be the one solution to help you navigate the market's ups and downs successfully. But when that promised solution doesn't deliver and the disappointment you naturally feel kicks in, it can obviously lead to a crushing blow, right? And so, over time, the cycle of going the ups and the downs can wear you down and ultimately contribute to a sense of burnout when it comes to investing. It's like starting each new detour with a sense of fresh optimism, only to end up disillusioned and tired when it fails. else. That's why sticking to a disciplined investment strategy is like following a reliable map on your road trip. Now, it may not promise the fastest or the most scenic route, but it offers a steady, peaceful journey towards your destination no matter what sort of obstacles you encounter along the way. Now, we discussed the pitfalls of reacting to market volatility, the emotional toll of deviating from your long-term plan, and how looking for magic pills can compromise your long-term vision. And so by now, I hope that it's clear how constantly changing your investment strategy can do you more harm than it does good. Because here's the good news. There is a better way. You don't have to be at the mercy of the market's ups or downs or your own emotions. That's because by sticking to a disciplined investment strategy from the start, you can navigate these challenges with confidence and peace of mind no matter what's going on in the markets. That's why when it comes to how I approach the markets, there are 3 critical steps that I take to ensure that I'm sticking to the plan and not the panic. So to start, when I'm concerned about what's going on in the headlines, I take the time to review my investment objective. Now, when you're investing, it's crucial to understand where you're going so you can choose the right path and stick to it even when the distractions come along the way. Indeed, without a clear investment goal, you might end up lost, disheartened, or doubting every decision that you make. So then the purpose of defining your investment objective is to clarify what your money's for. And so as you go about this process, you might encounter terms like preservation or income or balance or growth or appreciation, which all relate to what could be your ideal investment objective for your portfolio. But now, don't let this terminology confuse you, because ultimately what you're trying to do is determine whether your focus should be on preserving your investments from loss, growing your portfolio in a prudent way, or finding a balance between these 2 objectives. So then as I get started on the work, I'll typically ask myself, do I understand what my ideal investment objective is? Ultimately, knowing my investment objective helps me determine the right mix of stocks, bonds, and other assets that ultimately will help me navigate the market's ups and downs. But if you're still not sure what your investment objective should be, then go back to the basics and simply ask yourself what the money's for. This work involves understanding your values, like what's important to you, right? And then aligning your money with the life goals that are based on those values. And if you're still not sure which investment objective is right for you, then consider completing a risk tolerance questionnaire. This is one of the first steps that I take my clients through when we're preparing their investment policy statement. Either way, the big takeaway here is to ensure that you clearly understand the purpose of your investment strategy before making further decisions when you're tempted to make a move in the market. Now, once you have identified whether the objective of your portfolio is to preserve your wealth or to appreciate for the long term, then the next thing that you'll want to do is consider the gap between where your investments are now and your defined investment objective. Now, this process is like checking in to make sure you're on the right path to your road trip destination. So then after checking, if you notice that you're off course, then you'll naturally make some course corrections to ensure that you reach your destination without unnecessary detours or delays. Either way, it's about ensuring that your money is working just as hard as it should be as you're headed towards your ultimate goal. So then one of the first things that I do to evaluate this gap is to simply ask, is my current investment strategy aligned with the asset allocation defined by my investment objective? And so what am I talking about here? Well, let me give you an example. A family I worked with recently realized that their initial investment strategy for their children's college education fund likely wouldn't cover their anticipated expenses, given rising tuition costs and changes in their kids' educational goals. So then to make up for this projected shortfall, we first identified their ideal investment objective and then rebalanced their 529 holdings over to a more aggressive investment strategy to align with their risk tolerance and overall objectives. Now, this strategic shift ensured that they could support the child's education goals while maintaining their current contributions. And this approach not only set them up for success, it enabled them to avoid the need to take on significant debt down the road. That's why by asking the right questions and taking actionable steps, you can identify any misalignment in your investment strategy and make necessary adjustments sooner rather than later. And now the last but most crucial step in sticking to your plan so you can avoid the panic is to know when to simply stay the course. Warren Buffett, the Oracle of Omaha and famed investor, exemplifies how adhering to a disciplined investment strategy fosters trust in your own financial decisions, which leads to long-term success and peace of mind. That's why when Warren Buffett speaks, many investors tune in to hear what the man has to say. And so, when it comes to market volatility, one of Buffett's most famous sayings is to be fearful when others are greedy and to be greedy when when others are fearful. So then, despite the ups and downs that are inevitable when market volatility picks up, Buffett's keen observation about human behavior reminds us how essential it is to stay focused for the long term. So then, when I'm tempted to make changes in my investment portfolio because I'm starting to get nervous, I begin to ask myself, is my desire to change my investment strategy fueled by a legitimate need, or am I just starting to panic? This self-reflection helps me distinguish between making necessary adjustments and whether I'm simply making an impulsive reaction to some market noise. That's why it's crucial to resist any temptation to react to short-term market fluctuations and focus on your established investment strategy. Because ultimately, it's about being able to trust in the process and the foundational reasons for your choosing your investment strategy in the first place. When it comes down to it, the life goals that you're bound to achieve are ultimately within your reach. That's why it's essential to remember that the key to successful investing isn't about chasing the next sure thing or reacting to every market ups and downs when you get nervous. It's about having a clear destination, ensuring your investment strategy aligns with that goal, and staying the course even when the road gets bumpy. That's why when I'm tempted to panic because of what's going on in the markets, I'll take a moment to review my investment objective, check for any misalignments, and commit to my plan. When market volatility tempts you to buy an annuity or search for a home run stock, remind yourself of your long-term vision, how close you are now to that goal, and the disciplined approach that will ultimately get you there. Because if you fail to stick to your investment plan, you're not just going to lose your money, you'll likely compromise your future and miss out on the life that you've envisioned for yourself and your family. In fact, each impulsive decision you make now could chip away at the foundation of your financial future and lead to setbacks that can be tough to bounce back from later on down the road. But here's the good news. You don't have to be at the mercy of market fluctuations or your own anxieties, because by adopting a disciplined approach, you can navigate these challenges with confidence and peace of mind. And so imagine the peace and the confidence that comes from knowing that you're on the right path, that you're steadily working your way towards the life that you imagined, and that you're ticking all the right boxes. Picture yourself achieving financial independence, funding your children's education, and building a legacy that lasts for generations. That's the power of staying the course, because by doing so, you not only protect your financial future, but you'll also take one step closer to becoming the master of your own financial independence journey. To learn more about today's topic, you can visit the episodes page at legacygen1.com. And if you can find one person in your life who would benefit from today's message, please share this episode with them. But until next time, I'm Peter Donisanu, wishing you and yours abundant health and prosperity.
The Gen 1 Legacy Podcast is brought to you by Franklin Madison Private Wealth. Franklin Madison Private Wealth is a registered investment advisor firm with its registration and principal place of business in the Commonwealth of Pennsylvania. Registration of an investment advisor does not imply a certain level of skill or training. The information shared today is not intended to be personal, legal, investment, or tax advice, or solicitation to buy or sell any security or engage in a particular investment strategy. The commentary and forecasts are limited to the dissemination of and general information pertaining to Franklin Madison Private Wealth's investment advisory services and are based on economic and market conditions that are subject to change without notice. For additional information about Franklin Madison Private Wealth, including fees and services, please contact Franklin Madison Private Wealth or refer to the Investment Advisor Public Disclosures.